In this video, we'll be going through some of the topics discussed in our recent stock market overview webinar. In this webinar, we went through some of the basics of the stock market, types of stocks, and some statistics and major terms you should know when dealing with the stock market. If that sounds like something you'd be interested in, make sure you keep on the lookout for future webinars. But for now, let's get into the video.
Before we get started, let's go through some basic terms. A stock refers to the total financial capital a company is willing to sell to individuals in the market. A share is basically a unit of the stock, so think of stock as the yardstick, and each inch of it would be a share. And now a stockholder is anyone who owns shares of a specific company. And when you own a share, you essentially own a tiny fraction of the company.
Each share of a stock has a certain price, and like all things in a market, these prices are determined by supply and demand. While more people want to buy the stock, the demand increases while the supply stays the same, causing the share price to increase. On the contrary, when less people want to buy a stock, the demand decreases and the supply stays the same, causing share prices to fall. These prices can be represented using a stock chart, which tracks the price of a stock over time. And you may have seen these whenever you search for a specific stock online.
Just like with any market, the whole goal of trading in the stock market is to make money. And this is usually done by buying shares when the price is low and then selling them when the price is high to make a profit. But there's also another method of trading called shorting, where you sell borrowed shares of a stock when the price is high and then buy them back when the price is low to give back to the original shareholder. Most people usually short a stock when they expect its price to fall. But if it ends up rising, then these traders could be in some serious financial trouble.
Now let's talk about volume, which deals with how many shares of a stock are being traded. Trading volume is the total number of shares that are traded during the day. And even if the same shares are traded back and forth several times, the volume is counted on each transaction. For example, if 100 shares of a stock were bought and sold 5 times during the day, then the trading volume would be 500 shares. Dollar volume is the total value of the traded shares. So if each of those 500 shares were worth $5, then the dollar volume would be $2,500. Volume is important in determining how easily it will be to buy and sell shares without any delays, which can be important in case share prices start changing dramatically.
If you don't want to deal with buying and selling all the time, you might want to consider investing in an index fund, which consists of a portfolio of stocks and bonds that represent the market as a whole. Investing in an index fund is an example of passive investment, when you're not moving your money around much, and it is typically used for retirement accounts such as the 401k and IRA. These 3 indexes can be used as indicators of how the economy is doing and how you might want to modify your investments in the future.
Now that we've covered the basics of the stock market, let's move into the different types of stocks and why knowing them might be useful. Investors agree on 6 categories stocks can be grouped into, each with different categories, and they're useful in deciding on how to trade a certain stock. It's much easier to make decisions about a stock when thinking about its characteristics rather than its history.
The first type of stock we'll talk about is a value stock. Value stocks are those that trade at a lower price in comparison to what their companies are actually worth. This worth is determined by fundamentals such as earnings, sales, and dividends. And usually, stocks with good fundamentals are associated with higher prices, but stocks with good fundamentals that have lower prices are considered value stocks.
Cyclical stocks are those that depend on the health of the economy. During strong economic times, also known as bull markets, the stocks flourish. And during weak economic times, also known as bear markets, the stocks tank.
Income stocks are those of notable companies that are usually not volatile, making them relatively stable compared to other stocks. Income stocks usually pay out dividends or a percentage of stocks to their investors.
Next up, we have blue chip stocks, which are similar to income stocks in that they're from reputable companies with relatively low volatility. A key difference though is that blue chip stocks typically have a positive growth trend, making them a low-risk investment.
Speculative stocks are those from startup companies that usually sell new, untested products and have little financial history, making them pretty risky. And a penny stock is a specific type of speculative stock that trades for less than $5 per share. There's a high chance these companies fail or don't grow, but if they do succeed, then the payoff of the stock could be massive.
Finally, growth stocks are those from newly introduced companies that show recent growth. Similar to speculative stocks, they have little financial history, but because of their growth, their earnings could increase at a faster rate than the average company within the same industry.
If you want more information on the stock market, we encourage you to do your own research and attend our future webinars. At our live webinars, you'll get a lot more information and you'll have the chance to ask questions to our guest speaker. If you found this content useful, make sure to give this video a like and subscribe and follow to stay updated.